What risks are involved with trading in the markets? How can we manage these risks effectively to ensure we have the best chances of success? Welcome to this episode of Ahead of the Trade. Today, we are going to be diving in to the topics of risk management and position sizing. We're going to explore what risks are involved with trading and how we can effectively mitigate them, giving us the best chances of success. We're going to cover what position sizing is and why it must become a crucial component of your trading. We're also going to discuss mistakes that beginner traders often make with regard to risk management and position sizing. And finally, we're going to provide an actionable position sizing plan that you can use yourself to manage risk in your own trading. If you would like to download my position size calculator, as featured in this video, the link is in the description. As I'm sure you've heard, risk management is the single most important aspect of successful trading. Your risk management processes will quite literally determine your success as a trader. It is even more important than the strategy and the market that you are trading. But before you can make a plan to manage this risk, you need to know exactly what risk you are facing. The most obvious risk when trading is the risk of losing money. Your job as a trader is to manage this risk to the best of your ability. Crowds of people are lured into trading by online gurus who falsely preach about how easy it is to make money. Many of these people open brokerage accounts and look to begin placing trades without even considering the risk that they may lose their hard-earned money. Unfortunately, losses are an inevitable part of trading. Even the very best traders take losing trades frequently. For this reason, it is my recommendation that before you place any trades, you first develop a plan to mitigate this risk to the best of your ability. The most effective way we can mitigate the risk of losing money in the markets is to learn how to size our positions correctly. Position sizing is at the forefront of risk management. The size of our position refers to the number of shares, units, or contracts that we are trading at any given time. It plays a crucial role in determining the amount of money that we are risking on each trade. It is important that we have a structured approach to position sizing, as this will help us avoid taking any outsized losing trades. It also will help protect our account from wiping out, as many new traders unfortunately do. We have seen many beginner traders make the mistake of sizing their positions far too large and in turn, risking a very large percentage, if not all, of their account, causing them to wipe out completely and have to cease trading altogether after taking only a few losing trades. Our number one objective when trading, even above making money, must be to protect our capital at all times and ensure that we will always be able to trade another day. So how can we manage our risk effectively and ensure that we are sizing our positions correctly? I know of traders who like to risk a fixed dollar value on each trade, whereas others like to trade with a fixed position size, regardless of the specifics of the trade that they are taking. However, in my experience, neither of these approaches are optimal. Let's go through a common approach that many professional traders use. This is also the approach that I use in my own trading. It's called the 2% rule. The rule says you must never risk more than 2% of your account balance on any given trade. If you are only to risk 2% per trade, it would require 38 consecutive losing trades to lose more than half of your initial account balance. Losing 38 consecutive trades is a very unlikely scenario, even for someone who knows nothing about trading at all. This rule ensures you are able to lose many trades in a row without inflicting significant financial damage on your account. Additionally, by always risking a fixed percentage of our account balance on each trade, the dollar value of our risk will increase when we are performing well and will decrease when we are losing money. It is common practice amongst professional traders to increase their risk parameters when they are performing well and decrease them when they are not. We will automatically implement this added risk control measure as a function of the 2% rule. It is common human psychology to be tempted to increase our position sizes after a series of losing trades to attempt to quickly make back the money that has been lost. Unfortunately, this is a dangerous habit and a sure path to wiping out your trading account. It is imperative that we maintain consistent position sizing practices. By always sticking to the 2% rule, you remove your emotions from the equation and in turn, give yourself far greater chances of success over a sample size of many trades. Let's go through an example of how we work out our position size based on the 2% rule. The first step is to determine how much money we are going to risk on this trade. To do this, we need to work out what 2% of our current account balance equals. To find 2%, we need to use the formula, account size, multiplied by 0.02. This means that if I have a trading account of $10,000, my maximum risk size, due to the 2% rule, would be $200. Therefore, $200 is the maximum amount of money that I will risk losing on this trade. The next step is to determine my entry price for the trade that I plan to take. If you want to learn more about where to enter your trades based on particular technical charting patterns, check out my video on this topic. I've left the link in the description. For this example, I am going to be trading based on this ascending triangle pattern in the stock American Software Incorporated, listed on the Nasdaq exchange. As price has just broken out past the resistance level of the ascending triangle pattern, I decide to enter my trade here at $18. Before I enter any trade, I must always first define where I will exit the trade at a loss if I happen to be wrong. This step is essential to both managing my risk and sizing my position effectively. For this reason, I am going to set my stop loss in this scenario below the support line of this ascending triangle pattern here at $16. If the price were to break down below the line of support, the ascending triangle pattern would be invalidated and I would want to exit my trade quickly for a small loss. I will further explain how to place stop losses effectively in another video, as this is an extensive topic on its own. Now that I have established the amount of money that I plan to risk, as well as my entry and stop loss prices, I am able to determine how I shall size my position. The way I do this is by following the formula, risk in dollars divided by my entry price minus my stop loss price. For this example, I must divide $200 by $18 minus $16. This tells me that I shall buy a maximum of 100 shares in this scenario. This means that if I am to buy 100 shares at my entry price of $18 and the ascending triangle pattern fails, and instead of breaking out higher, price breaks down below the support line and triggers my stop loss at $16, I will lose exactly $200, which equals 2% of my trading account. Because I always trade with this rule, I will never lose more than 2% of my trading account in any one trade, and the majority of my capital will always be protected, ensuring that I am very unlikely to ever wipe out my trading account. It is important to note that it is essential that our stop losses are always set in a logical place in the market and that the number of shares that we buy is determined by where our stop loss is set. Never shall we determine the location of our stop loss based on how many shares we want to buy. That is a recipe for disaster, as I will elaborate on in my stop loss video. When trading, you may often be required to work out the size of your position very quickly and whilst under pressure, ensuring you do not miss your entry opportunity. Often going through the calculations to determine your position size manually is less than ideal and may cause you to miss a trading opportunity. For this reason, at Ahead of the Trade, we have developed this position sizing desktop app that the members on our team use daily in their own trading. We have decided to make it available for you, as we believe it will help you remove the emotion from your position sizing process and follow the 2% rule with ease. Let's go through the same example again, but instead, this time we will use our position size calculator and see how much faster and easier the process is. I enter my capital, $10,000, my risk percentage, or risk as a dollar value, my entry price, $18, and my stop loss price, $16. Instantly, it tells me I can buy a maximum of 100 shares. As many traders use margin accounts, there is an option to set your margin multiplier in the Settings tab of the calculator. If you would like to use this calculator, the download link is in the description. It has been optimized for ease of use and to take up minimal screen space so it won't interrupt your trading. I encourage you to try this calculator out for yourself and to experiment with entering different entry and stop loss prices to see how this will drastically affect the maximum size of your position. If you are a beginner level trader or you are experimenting with a new trading strategy, I recommend taking further risk control measures until you have proven to yourself that you are able to make a profit. These additional precautionary measures may include either beginning trading with only a fraction of your total capital or alternatively, limiting your risk to 1% as opposed to 2% until you show that you are able to produce a profit over a series of many trades. You must understand that the 2% rule does not mean we have to risk the full 2% of our capital on each trade. Instead, 2% is the maximum risk that you should accept at any given time. There is nothing wrong with risking less than 2% as long as you are following a structured position sizing approach. Furthermore, you may wish to include any broker commission charges as part of your 2% allowance. I'm sure that you now have a far better understanding of the importance of risk management and effective position sizing whilst trading. Unlike what many online gurus may tell you, becoming a successful trader is a long process. It is important that you do not try to rush this process by accepting excessive risk. Remember that as a trader, it should be your primary objective to protect your capital. This is even more important than making money. The way we do this is by implementing the 2% risk rule when it comes to sizing our positions, which ensures that the majority of our trading capital will always be protected. If you have found this video to be helpful, consider giving it a thumbs up and subscribing, as it will help the video get recommended to others by the YouTube algorithms. If you would like to further support the channel and take a sneak peek at our behind-the-scenes notes, as well as a few other perks, we would greatly appreciate you becoming a Patreon supporter. I have left a link in the description. Make sure you let us know in the comments what trading topics you want us to cover next. See you next time on Ahead of the Trade.